Right now, the stock market is trading at all-time highs. A massive part of that enthusiasm came from investors heavily banking on a series of interest rate cuts expected throughout 2026. But to understand why those cuts aren't coming, we have to look at the catalyst. This line chart tracks the federal funds rate. When inflation hit 9.1% in June 2022, the Federal Reserve responded with the fastest rate hiking cycle since 1988. They pushed rates up 425 basis points, which is 4.25 percentage points, eventually peaking at 5.5%. Since then, the Fed has marginally brought rates down to 3.75%. But look at how the projection line flatlines through 2026. The expectation of 4 or more immediate rate cuts has completely vanished. Current probabilities show interest rates remaining unchanged until March 2027. Many investors brush this extended timeline off, pointing to a single achievement. Since 2020, the United States has been a net exporter of oil. The assumption is that because we produce so much domestic energy, we are insulated from the global supply shocks that cause inflation. But that defense relies on a complete misunderstanding of our infrastructure. Leaning on our net exporter status leaves everyday investors blind to a severe physical vulnerability that is actively keeping interest rates high. The problem is a structural mismatch. The U.S. produces record amounts of oil, but it is physically incompatible with the refineries built to process it. Our domestic drilling yields what is known as light sweet crude, but historically, U.S. refineries were configured to process heavy sour crude, a much denser, darker oil that requires specific heavy-duty processing facilities. Because our refineries cannot efficiently process the light oil we pull out of our own ground, we still have to rely heavily on international suppliers to provide the heavy crude our infrastructure needs to function. Look at this bar chart built from U.S. Energy Information Administration data. For the week of April 3rd, despite our massive domestic production, the U.S. actually imported 2.1 million more barrels of oil than it exported. We do manage to utilize about 60% of our domestic output, but this massive shortfall leaves the U.S. economy directly tethered to vulnerable global supply chains. When prolonged geopolitical conflicts disrupt the shipment of international heavy crude, domestic energy prices surge, independent of how much light crude we pump at home. And that surging price of imported oil feeds straight back into the Federal Reserve's ongoing struggle to control inflation. Higher energy costs bleed into the broader economy, creating sticky inflation, driving up the cost of housing, makes corporate borrowing more expensive, and compresses tech sector valuations. This physical refinery mismatch is the hidden anchor tying down the economy. It forces energy costs up and directly prevents the Federal Reserve from lowering interest rates. While the U.S. can absorb these high energy costs longer than most, prolonged global conflicts are hitting other economies much harder. Asia, in particular, is taking the brunt of the impact. This map isolates the Strait of Hormuz, a critical maritime choke point. Currently, nearly 80% of Asia's oil flows directly through this narrow corridor. As supply lines strain, we are seeing a cascading international response. Countries across Africa, as well as India and Australia, have already implemented immediate restrictions on oil use. This creates a macroeconomic threat that acts as a dual pressure vice, actively crushing the global market from two opposing sides. On the left side of the vice, you have slowing global economic demand. International energy restrictions force factories to slow production and consumers to spend less. On the right side, you have the punishing reality of higher for longer interest rates, locked in place by the sticky inflation we traced back to imported heavy crude. Right now, the market is suffering from a dangerous blind spot. Current stock valuations are aggressively pricing in a quick resolution to global conflicts, ignoring this dual pressure entirely. If global tensions extend longer than the market anticipates, the combination of slowing international demand and frozen interest rates could trigger a full global recession. This means investors need to stop building portfolios around the expectation of upcoming rate cuts. The environment requires a shift toward active defense, using tools like options to intentionally hedge against a market downturn. When the market is actively squeezed by slowing demand and high borrowing costs, active hedging is the most reliable way to protect your wealth. Global markets are currently operating in a state of high tension. While the Middle East faces its most significant instability in years, the U.S. stock market has remained surprisingly resilient. The news cycle has become a series of contradictions. Reports of a ceasefire deal are often followed within hours by renewed missile strikes and the immediate reversal of diplomatic agreements. Specifically, these tensions are concentrated at the Strait of Hormuz, a geographic choke point that handles a significant portion of the world's energy transit. This chart tracks the volume of commercial shipping through the strait. Following the start of the conflict in March, the volume dropped from its historical baseline to nearly zero as the shipping lanes effectively closed. During a brief 48-hour ceasefire, we saw a minor increase in traffic, but this recovery was marginal and stayed well below historical averages. Once the ceasefire failed, the strait closed again. The traffic volume returned to its previous lows, nullifying the brief period of activity. This constant shift in the geopolitical landscape makes it difficult for investors to rely on standard fundamental analysis or macroeconomic forecasts. In March, the S&P 500 nearly entered correction territory as the shipping lanes were first cut off. However, the market sentiment shifted rapidly in April. The Nasdaq recorded 13 consecutive winning days, pushing the index to new record highs despite the continued blockade. By reaching these highs while the primary supply route for oil remains unstable, the market is effectively betting on an immediate and peaceful resolution to the conflict. Because current valuations are based on the expectation of a swift end to the war, any evidence that the conflict will be prolonged creates the potential for a sharp market sell-off. The primary catalyst for a shift in market direction is the sustained price of oil. While consumers focus on these rising prices at the gas station, the broader economic risk comes from oil being an essential industrial baseline. Oil functions as an invisible tax on global trade. It dictates the cost of shipping, the expense of running a factory, and the price of raw materials. When these fundamental input costs remain elevated, businesses are forced to choose between two difficult financial strategies. In the first scenario, a company absorbs the higher operational costs. This preserves their customer base, but directly lowers their profit margins and overall earnings. In the second scenario, the company passes the cost to the consumer by raising prices. This protects their margins, but risks a significant drop in demand for their products. Regardless of the choice made, sustained high oil prices act as a drain on corporate profitability across nearly every sector of the S&P 500. If companies raise their prices to offset oil costs, the economic impact eventually reaches the individual consumer. Households prioritize their spending based on survival. Rent, utilities, and basic groceries are non-negotiable expenses that must be paid regardless of inflation. To compensate for higher costs in these essential areas, consumers reduce their discretionary spending. This creates a direct headwind for specific industries. Retailers, travel providers, cruise lines, and delivery services like FedEx or UPS are often the first to see a decline in revenue. For investors holding discretionary or consumer-facing stocks, a long-term conflict in the Middle East represents a persistent threat to portfolio value. When higher costs for shipping and manufacturing are passed through the supply chain, they contribute directly to the national inflation rate. Investors often monitor core CPI as their primary gauge of inflation, as it excludes the direct, volatile costs of energy and food. This chart shows the core CPI basket. While direct energy costs are stripped out, the price of oil is already embedded in the remaining sections. The energy used to manufacture goods and provide services is still reflected in those final prices. If these embedded costs keep inflation above the target rate, the Federal Reserve is pressured to take action. In 2022, when inflation reached 9.1%, the Fed responded with the fastest rate hiking cycle since 1988 to cool the economy. While the daily headlines focus on political negotiations, the long-term health of the market depends on the price of oil. If energy costs stay elevated, a systemic correction becomes increasingly likely.